Welcome everybody, and a special shout out to my subscribers, the Investorholics. This is another ETF Spotlight review. Hopefully we'll get some very good information out of this one as well. Today we were looking at IIND, which is the BetaShares India Quality ETF. With this ETF, investors can get exposure to one of the fastest growing economies in the world, with future growth potential underpinned by strong structural reforms, or it appears there's some structural reforms on the way. IIND holds a portfolio of the top Indian companies ranked by their quality score, which we'll touch on later. The fund is a quality-based approach, and it seeks to exploit the inefficiencies in the Indian share market. Stick around, guys. Interesting just to learn about other economies, and you might be interested in using this ETF as a diversification. Well, hello there, Investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances, expand your investment horizons, and crack your financial sky. Okay, let's dive on into it. Investment objective of the fund: it aims to track the performance of an index before the fees, expenses, and all that malarkey. Provides exposure to a diversified portfolio of high quality Indian companies. Provides access to a diversified portfolio of the 30 highest quality Indian companies based on a combined ranking of the following key factors. So you're looking at high profitability, low leverage, and high earnings stability. Why would we bother with this one? If you own this ETF, you'll get some tactical exposure to Indian equities. India is one of the fastest growing economies in the world. Future growth potential underpinned by strong structural fundamentals. Indian equity returns have historically had relatively low correlation with both Australia and global equities, thus aiding portfolio diversification. So we're trying to smooth out the lumps and bumps in your portfolio. You want to have investments that aren't necessarily linked to each other. So if something happens in Australia, part of your portfolio is invested, say, in this ETF in India, and hopefully the Indian economy is in a different part of the cycle to the Australian economy, so it tends to balance out your portfolio a bit, so you don't see the deep dives that you might if you're only invested in the Australian market. Okay, looking at a net asset value of $7.32, closed out just above that at $7.40, market cap of just over $20 million, relatively small ETF, started trading less than 12 months ago, so the track record's not that long. Management costs 0.8%, which is a little bit high, but pretty much the way this is set up, there's a few extra management costs associated with it because it doesn't actually follow index. You get a distribution semi-annually, dividend yield of 1.68%, measured up reasonably well globally. It's pretty much on the low side if you're looking at the dividend yield of Australian stocks anyway. So 1.3 billion people. So India has a burgeoning middle class population, one of the largest in the world, and the GDP in that country is growing very fast. It is now the second fastest growing economy alongside China. The growth is predicted to continue at that pace of around 7% for the next few years, according to the World Bank. We'll see how that really comes about, or if it comes about, I should say. India is the only major Asian country that saw a share of its global export market grow since the start of the trade wars. So, that looks to be in a good position anyway, but something to definitely keep an eye on. So I've always been somewhat cautious or skeptical about investing in India because at times it seems to be a country that struggles to live up to expectations, and there's a multitude of reasons for that. It's quite a large country and it's still definitely underdeveloped. So there's lots of potential, but whether they actually realise that potential is another thing. Looking for alternatives, do some research on NDIA and also have a look at Asia. NDIA is set up very similar to this, except that it uses a fixed index. Asia is more of a broader general Asia focused ETF. So IIND has not actually been in existence for 12 months even yet. So it was listed on the 2nd of August 2019. Pretty much all the gains have been wiped out since the end of February after the big crash due to COVID-19, and that obviously hasn't rallied back up to those highs again, because as you can see, since inception you're down just over 6% there. A good cross-section of industries and different companies in the top 10 there. There's a few names you might recognise: Unilever, Tata, although Tata has got a lot of companies, a lot of subsidiary companies that are actually listed in India as well. They're a massive company. Local version of Suzuki, Nestle India, and this Avenue Supermarkets, never heard of them, but obviously if they're sitting in the top 10, they're probably quite large as well. And it's also some housing development, so nice cross section of industries there. So definitely, if you're interested in this one, have a look at those a little bit more in depth, just so you get an understanding of who they are and what they do, because they'll actually drive a lot of the returns for this ETF. So if you are interested in India and the potential rise of India, like I say, been waiting for it for quite a while. I've been looking at and watching for over 10 years, but haven't really seen much to date. But obviously potential's there, so maybe it's just one to put in your watch list and just keep an eye on it for the time being. Or if you're really keen, make a small investment and just watch it that way, which is what I tend to do sometimes. I'll just put a few dollars in and just have it in my portfolio, and that sort of keeps it at the front of your mind. And if it starts to move, the Indian economy starts to change and becomes more efficient, and you actually start to see an uptick in the economy, then it might be time to buy it then. But until then, I'd hold off. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's Crack the Sky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.